GAMESYS is an online gambling company that's experienced a boom in popularity since the pandemic began. GAMESYS has been a beneficiary. More people have had time on their hands during lockdowns and on furlough to go online. The company owns Jackpot Joy and other online bingo and casino sites like Rainbow Riches and Star Spins. It's doing especially well in its UK and Japanese markets, and it's also worth watching out for further expansion in the US this year, where the company already has a foothold. A modest valuation multiple and decent dividend yield make the shares interesting. Idigen supplies regulatory and compliance solutions to companies within highly regulated industries. These include things like audit, risk, and compliance software for financial services and banking. Also supplies safety and quality management software for airlines, food companies and the oil industry. And it's got an impressive track record of acquisitions. It raised 49 million in December and has spent over half of that on a company called Harmony UK Holdings, better known in the industry as Huddle. Now expect more action this year, which could well be reflected in an improved share price. SCAPA supplies tapes and adhesives to the medical industry and to car manufacturers and others. That's been lucrative in the past, but the postponement of elective surgeries during the pandemic has hurt. Orders from the automotive and construction industries are down too. Now, the company lost a big contract a few years ago and it still bears the scars. However, business is recovering fast and the current valuation multiple for next year drops significantly. The PE ratio will be at a significant discount to its long-term average, but I think that gap could narrow this year as we see further evidence of recovery. Diversified Gas and Oil focuses on production rather than exploration. It acquires projects, then improves margins. That produces cash flow, which it uses to pay one of the most generous dividends around. Crucially, its low-cost model means it can operate effectively even when commodity prices are low. And while the sector has had a tough period, Diversified still raised the shareholder payout by 7%. Now, I've spoken with the company before, and the CEO tells me the dividend and the payout ratio is non-negotiable. AEW UK REIT is a real estate investment trust. Commercial property has been out of fashion, but this trust, run by highly experienced real estate managers, directly owns a broad portfolio of regional UK commercial property assets. Its net asset value held up well through the crisis, and rent collection speeds do keep improving. Dividends have been consistent too. It's paid a 2p dividend each quarter and is on track to return 8p for the full year. M&G is a well-known insurance company, and on paper, the stock looks cheap and has an eye-catching dividend yield. A near 9% yield suggests the market believes that dividend may be cut. However, M&G can afford the current payout, and even if it did cut the dividends by say 30%, the shares would still yield 6.3%. We'll find out at the annual results in early March.